Every decision shapes your business, but one choice echoes throughout its entire journey, influencing operations, taxes, assets, and liabilities. Your business structure. In Australia, there are 4 primary business structures. Many start off as a sole trader, which is the most basic of the 4 because you operate the business in your personal name. This is ideal for small businesses and people who prefer to keep things simple and manage all aspects of their business. Alternatively, you might want to go into business with someone, in which case you would opt for a partnership. This is a collaborative structure where 2 or more individuals or entities manage a business together and is most suitable for people who also want to keep things simple but want to share profits, responsibilities, and liabilities. If your business expands, you might want to change your sole proprietorship or partnership and move towards a company structure, which is a legal entity separate from its owners. The benefit of running your business under a company is that you have asset protection thanks to limited liability, and you're in a better position to raise capital through the sale of shares. And then you have a trust, which is an entity that holds property or income for the benefit of others. This structure is often used by those who wish to protect assets and benefits from a flexible approach to distributing income. Now, you may already have a structure in place or preference, but our proposal would always be to set it up like this. Here you can see you have the operating company, the discretionary trust, and the corporate trustee. The discretionary trust is essentially the sole shareholder of the operating company. It generates income, part of which can be distributed as dividends to the beneficiaries of the trust as part of the corporate trustee's discretion. The corporate trustee manages the trust's assets. With this kind of setup, you achieve asset protection, have separate operational management from income and capital benefits, and limit liability to the paid-up share capital of the company. In other words, if you get sued for any reason, your creditors can't come after your company because the trust owns it. Now, this was just a basic example, but this wouldn't necessarily work for more complicated businesses. For example, let's say you run a boutique store but have been presented with an opportunity to expand and open another branch of your store in a different location. In this case, I would suggest a structure more along the lines of this. As you can see, we've inserted a holding company or a unit trust in between the discretionary trust and the operating company. And there are a few reasons why you would do this. For starters, isolating each business or shop into separate companies safeguards against the failure of one affecting the other, resulting in far greater asset protection. You're also giving investors the opportunity to engage at various levels, either at the holding company level or at the individual business level. You can choose to offer shares to employees in specific businesses or companies, rather than in the entire business at the holding company level. There could also be capital gains tax benefits should you decide to sell one of the shops. For example, you could sell the entire company with CGT accruing in the family trust's name, potentially accessing small business entity concessions to minimize capital gains. And this structure potentially allows for the sale of individual businesses or companies without needing to establish new entities for various businesses in the group. So, with this advanced structure, each business or shop operates as a separate entity under the umbrella of the holding company or trust. The result? A robust framework for asset protection, investor and employee engagement, and strategic financial management, all while also ensuring regulatory compliance and operational flexibility. What I am trying to show you is that yes, you could choose one of the 4 basic structures, but if you dive deeper, you'll find that a hybrid or more complex structure might be the key to not only safeguarding your assets, but also ensuring the longevity and sustainability of your business. The structure you choose should be a reflection of your business's needs, your financial strategy, and your future aspirations. Whilst the 4 basic structures serve as a starting point, remember that your journey doesn't have to be linear. It's okay to start simple and get complex as you grow, or to restructure when the tides of the business world shift. The key is to remain informed, be adaptable, and always ensure that your structure aligns with your strategy. On that note, if you have any questions, feel free to leave them in the comments section below or speak directly with a business services accountant at Equil Advisory about what structure is right for your situation.